The global drone services market is projected to reach $555 billion over the next 10 years. That is a massive target. That massive trajectory creates a gold rush. We are seeing a surge of aggressive microcap companies scrambling to secure everything from local agricultural mapping to frontline defense contracts. This chart plots the current landscape, with risk on the vertical axis and growth potential on the horizontal. Traditional defense contractors sit safely in the low-risk, lower-growth corner. But to understand the extreme trade-off of this sector, we have to look at Zenitech, sitting entirely alone in the top right corner. Zenitech's corporate pitch revolves around a drone-as-a-service model. They are attempting to rapidly expand their footprint across enterprise software, agriculture, and military logistics simultaneously. The question is whether buying up legacy service companies and testing hardware in active war zones actually builds a defensible business, or if their massive cash burn will simply dilute current shareholders to zero. When evaluating a penny stock like this, you have to throw out marketing buzzwords like quantum and AI. The only things that dictate survival are the balance sheet and operational execution. Zenitech's primary expansion mechanism is not building from scratch. It relies heavily on acquiring established, low-tech service providers, like their recent purchase of a legacy land surveying firm. They take a legacy surveying firm, integrate proprietary drone technology, and aim to output high-margin drone-as-a-service revenue. But modernizing requires heavy upfront capital. If customers resist the transition, that integration creates a massive operational bottleneck and severe friction. Purchasing top-line revenue through acquisitions is a straightforward transaction. Organically scaling the profit margins of those acquired companies is the actual test of corporate survival. Internationally, Zenitech is executing an even more aggressive move, establishing active manufacturing and dedicated testing facilities directly inside Ukraine. Their stated focus there is producing and testing sub-$5,000 one-way expendable interceptor drones designed specifically for defense customers. The Ukrainian theater offers an intense, real-world combat environment. Successfully deploying systems here accelerates product validation for U.S. allied forces far faster than a domestic lab environment. However, operating in an active war zone means the company's physical assets, capital, and supply chains are exposed to a daily risk of geopolitical destruction that standard technology firms do not face. There are domestic political tailwinds providing a potential catalyst. Recent executive orders from Donald Trump aimed at boosting U.S. allied drone manufacturing and deployment directly align with Zenitech's defense strategy. Frontline validation is an incredible asset for securing defense contracts, but it forces investors to accept extreme geopolitical risk directly on top of the standard risks of holding microcap equity. To see if this strategy is actually working, we have to look directly at the objective evidence from Zenitech's third-quarter financials. This split-screen chart illustrates the marketing hook. On the left, we see a massive 1,200% spike in year-over-year revenue. But look at the right side. That revenue came at the direct cost of an $8.2 million surge in expenses. The cost of running the business completely dwarfed the top line. And here is the immediate threat. Zenitech currently holds just over $10 million in cash. Given their new burn rate, that runway is dangerously short. In the microcap space, pairing a high cash burn rate with low cash reserves leads to a predictable outcome. The company will likely have to issue future stock offerings, severely diluting current shareholders just to keep the lights on. Despite the balance sheet, retail traders are interpreting a different set of signals on the daily stock chart. The price action is heavily compressing against a proven $2 support floor. Buyers have historically stepped in at this exact level to trigger multiple bounces. Below the price, there is a clear bullish divergence forming on the RSI. The indicator is making higher lows while the price grinds downward, showing that the selling momentum is quietly losing steam. However, if a penny stock is forced to announce sudden share dilution to survive its cash burn, technical support lines become completely meaningless. Technical analysis can point out a mathematically sound entry zone, but only the underlying fundamental health determines if that floor will actually hold under pressure. Zenitech is an aggressive growth experiment. They are balancing right on the edge of advanced operational deployment and serious financial strain. To decide if this fits your portfolio, we can use this decision scorecard to map your specific risk tolerance to the reality of the stock. For the swing trader, The predefined $2 support zone and the RSI divergence offer a clear opportunity for a tight stop technical play. For the growth speculator willing to stomach extreme volatility, the Ukraine combat validation and the ongoing acquisition strategy provide multi-bagger potential. But for the value investor, the ballooning overhead costs, dependency on acquiring legacy firms, and the high mathematical probability of shareholder dilution make this an immediate pass. Discard the internet hype. If you choose to invest, treat this strictly as a high-stakes race between Zenitech's ability to scale their operations and their rapidly depleting cash runway. Invest accordingly.